Hey, good morning, everybody, and welcome to this Trading Places Live. It is Tuesday, March the 3rd, already into March, getting close to the end of the first quarter already. Hard to believe. But anyway, I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. Pleasure to be with all of you again today. Yesterday, big scare over the weekend with the bombing in Iran and start of potential war. Who knows how long this is going to last? Just one more thing for the market to think about. We got, of course, the tariffs and the Supreme Court decision not that long ago. We also had inflation coming in a little higher than expected recently. So we've just got issues that the market's trying to deal with. And beginning of the year, when I talked at Market Vision, I said, I really don't know what kind of news we're going to get. There's always something that the market likes to point to, and all the analysts like to point to that's keeping the market back or driving it lower. But the warning signs were out there. Market has been continuously nervous. We can see that with the volatility index remaining up above the 20 level, or we keep moving up. And ever really since the beginning of the year, the VIX has been on the rise. You can kind of look at a longer term chart going back at least the last few months, maybe a year, and take a look at that rising VIX over the course of the last several weeks. Even though the market hasn't broken down. I mean, the market, we've had repeated attempts up at 7,000 trying to break out to all-time highs, but doing it with a VIX that makes you think that we're in some sort of a bear market or maybe on the verge of one. And who knows, maybe we are, but I don't think it's going to be that deep. But, yesterday we were able to stave off a potential breakdown, which I thought was good for the market. We did get a gap down. I think the S&P went right down to that 67.97 level and then abruptly turned back to the upside. Well, we got another test today. It's going to be interesting to see whether or not we open. We'll look at futures here in just a minute, but it's going to be interesting to see if we open below that 67.97 level on the S&P 500, because it does look like we're going to be pretty close to that area. I've still got 30 minutes to go before the opening bell, so anything can happen. But anytime we gap open below a key support level, it makes me a little bit more nervous than if we just go through intraday. A lot of times you get those kick saves, you get hammers at print and so forth. But when you open down below key support, a lot of times, in my opinion anyway, that is a signal that we could see some additional selling. So we'll see how all that plays out as we go throughout the day today. But futures are weak. And again, we'll just have to wait and see how that all plays out. Let's take a look at what happened yesterday in the market, and then we'll look at those futures. Dow Jones Industrial Average yesterday down 73 points. NASDAQ up 80. S&P 500, you can see, was pretty flat, up 2. Percentage-wise, no big deal. Everything kind of green. But did you notice, with the market being green, almost all the indices green, that the VIX was still up 8% yesterday, finishing at 21.5. That's that's a little bit of a warning sign. Well, it's a big warning sign, because the volatility index, if you know how it's priced, it's based on the spread or the premium that's paid on short-term S&P options. And who sets those premiums? Market makers. So I like using the VIX in connection with the equity-only put-call ratio, because it's giving us two different angles of sentiment. This one, the volatility, being the one that's kind of looking at what market makers are doing. And then, of course, the equity-only put-call ratio gives us an idea of what actual traders, a lot of retail traders, are thinking about the market. And we know, from long-term experience, that retail traders as a group tend to get everything wrong. And so when they're really bullish, that's when you need to be a little careful. And when they're really bearish, that's when probably should be looking for a bottom. And we're starting to grow a little bit more bearish. I think if we get a breakdown, I think you'll start to see the equity-only put-call ratio really pick up, maybe go up above that 5-day moving average of the equity-only put-call ratio, could move above 0.75, which would be the first time in a long time that we've seen that. But that's projecting. We're going to need to see some more market weakness and a little bit more fear creeping in the market before we see that. But in the meantime, looking at the VIX, it does kind of paint this picture where market makers are expecting that we're going to have a lot of volatility ahead. That's what the VIX tells us. And when the VIX is in the 20s, normally we see a VIX in the 20s when the market has already sold off and we've lost support and so forth. In this case, we haven't lost support. So it's just telling me that the market's nervous and is not likely to handle bad news very well. And so we saw that a little bit on Monday morning when we got the word over the weekend of the Iran U.S. conflict escalating, oil prices shooting up, and you saw what happened. We had a big gap down to open the day. Now the bulls did recover, and so we'll see what happens from here. But I want to go through real quick and just take a look at futures with you just to see where we are right now. So the diamonds right now down 1.8%. Down at 480. The S&P 500, oops, wrong symbol. Spider, down 1.75%. That is going to take us down below the 67.97 level. If we open down 1.7%, the S&P 500 closed yesterday around 68.80. So you take 1%, that's 69 points. And then 3/4 of that would be roughly another 50, 52 points. So we're talking about roughly 130 S&P 500 points to open. And that would take us down to about 67.50 based on where we are right now. Now, again, we've got another 25 minutes to go till the market opens. Maybe we get, reversal here and we open, we hold on to support at the open and maybe bounce again, but it doesn't feel like it. It's been feeling like it to me for a while that the market wants to go lower. And certainly the bears are going to have an opportunity at the open unless things really improve in the next 20, 25 minutes. So that was your S&P. Then, of course, we've got the QQQ, which is down 2.1%, down $13. And the IWM, which is down 2.5%, almost $7. So definitely taking a big hit this morning in the pre-market, and we'll just see whether or not we rebound. Now, one thing to keep in mind is that yesterday with the big sell-off at the open, we saw buying throughout the rest of the day. So most of the day yesterday was buying. That hasn't been like the norm, but that was yesterday. And so when we get another big gap down today, it'll be interesting to see whether or not the buyers are out there again today, continuing to buy everything up, or whether this is the breakdown that causes a little bit more panic. And when the VIX is up in the 20s and we get a breakdown, history tells us that the selling can escalate quickly. A lot of times high VIX and a breakdown leads to impulsive selling, a little bit more panicked selling. And when that occurs, market makers usually what I call go on vacation, because normally they should be there supporting the market when it drops, buying when everybody wants to sell. But when there's too many folks selling and the volume is too great, they go on vacation. That's why the drops tend to be rather precipitous, whereas gains tend to be very slow and boring in the market. So that's where we're sitting right now as we get ready to open Tuesday, March the 3rd in the market. We'll see whether or not the bulls can bounce back or not. Looking at the sectors from yesterday, energy, of course, with the big oil spike, energy stocks were up over 2% or up 2% yesterday. That was a safe haven place. We had industrials that were up 1%, technology up 0.5%, but because we did get that recovery at the end of the day, well, after the opening bell where we saw the big sell-off, and then real estate, the only other group that you can see was up for the day, up about 0.2%. And then we had 7 groups that were down, led by healthcare, consumer discretionary, consumer staples. Staples been one of the best groups in the market of late, but that group took a hit, biggest drop yesterday. And healthcare, which had just broken out on Friday, actually saw a pullback on Monday, which was a little surprising. I thought we might see a little follow through there, but it'll be interesting to see how this sector, how all of these sectors perform and the relative strength here. If we go into, hold on one second. Sorry. If we go into a little bit of a tailspin today, especially at the open, does money rotate back into technology, or are we left with a lot more defensive stocks leading today as a result of potential breakdown? I would expect the latter, but who knows? We're going to find out. All right. S&P 500. So yesterday there was the gap. I'm going to really shorten this down. Let's just look at the last 3 months because you can really get a better sense of the volatility and the back and forth action. Yesterday, you can see, look at this low yesterday, 67.96.85, literally 67.97, number we've been talking about. We went right down there, hit it yesterday morning, and quickly buyers came back in. So everybody was there waiting for the buy. Well, not everyone, but bulls were waiting to buy at the lower end of this trading range. They jumped in. We saw a big rally, and now we're back at it again today. Although today it looks like we're going to probably, looks like we'll probably break down at the open, and then we'll see whether or not, we can hold the last low, which was all the way back in December of 2025, which was down closer to that 67.20 area. Next up, let's take a look at the NASDAQ 100. NASDAQ 100, same thing. 24.5, 24.6, that area is what we're watching. Yesterday, we opened at about 24.6, rallied back strongly throughout the day. Now the question is, do we hold 24.5 today? And it doesn't look like we're going to at the open with that QQQ down as much as it is, but that's where we stand. IWM, again, let's zero in on that last 3 months because we're looking at opening down around 257, which would be just above the key support from earlier in February. So small caps, which have been outperforming on a relative basis, do look a little bit better still, even with the gap down today, in that it's holding its support. Again, we don't know where we're going to open when the bell rings here in a few minutes, but at least based on what we just looked at, it looked like we were going to hold on to that support level. Transports, again, zeroing in. This actually still looks pretty good. Big breakout, moving back, but I don't know, almost looking like it's a little bit of a ascending triangle kind of a pattern. I don't know, little maybe not a great one, but continuing to trade up near its recent high. Of course, with everything getting hit today, I would suspect that we're going to have a pretty big drop at the open. I think on the transports, I'd be watching maybe this breakout level at about 18.5. So that would be about 1,200 points lower from where we closed on Monday. Still quite a bit of room to the downside here to hold up on the chart. All right, moving on to the S&P 500 here. I wanted to bring up a lot of these ratios that I like to follow because they are continuing to be weak. I think that is a problem for the market. I know a lot of you like to follow breadth. I get comments all the time. I get emails. I've seen comments on YouTube. Folks thinking, okay, we're okay because the breadth has been strong. Breadth isn't what drives the stock market. It's the high market cap companies. It's the high growth. It's the big, large cap growth names. It's the Mag 7. If you're interested in calling the S&P 500, now, if you want to invest in other stocks and they're going up, then yes, I agree. You still got plenty of options. But I'm talking about those, when I talk about the market in general, I'm talking about the S&P 500. What drives the S&P 500, without a doubt, are your Mag 7 stocks and your large cap growth names, mostly in software and semiconductors. That's the big thrust. If those areas are not performing well, the S&P 500 is going to struggle. I don't care what the rest of the market's doing. I mean, if the rest of the market's doing okay or doing well, then it'll kind of hold the market up like it has for the last couple of months. But we're not going anywhere. In order for the S&P to actually move up, we've got to get strength in the Mag 7. We've got to get strength in those large cap growth names. And we've done okay with some of the semiconductors. The problem is that the semiconductors that carry the most weight in the S&P 500, NVIDIA, Broadcom, AMD, those stocks are not doing well on a relative basis. And that is the big part of the problem. So many of the semiconductors are doing well, but many of them are mid caps and small caps. The larger caps, the ones that really drive the market, are struggling. Just about all of software is struggling. And then throw in the Mag 7, and that's been the problem. And so we'll see whether or not those groups can bounce back, because if they don't, as I said, it's going to be difficult for the S&P 500 to push higher. And with the VIX where it is, fear building, news negative, you can kind of see where this could be heading. And so just be careful out there. That's what I've been talking to members about since the beginning of December. I thought it would be a choppy year. I said that I don't think we're going to see a cyclical bear market. I still don't. But I wouldn't be surprised if we see a correction. And certainly I wouldn't be surprised to see the 6,500s on the S&P 500. That's not a correction. Correction would need to go back down to about 6,300. But I think if we lose 6,500, I think we'll go back into the 6,100s. So I'm looking at two key areas of support on the S&P 500. I think 65.25 to 65.50 will be one key one. And I think the really big one is 61.44. And I don't know if we're going to get down there or not, but I would be pretty bullish. Well, I mean, we'll see how the market is heading. Obviously, if we get down there, it's not going to look good, but that doesn't mean the market won't bottom there. That would be a level that I certainly would be getting very interested again from a long perspective. I would be interested in 6,500s, but definitely 61. All right. For those of you that are new to Earnings Beats, go on over to our website, earningsbeats.com. You can start your no-cost trial. We do have a 30-day free trial. You can check that out. We've got a lot of good stuff out there for our members. I don't know if you've seen our portfolios. The aggressive portfolio in 1 week is already up 8%, which is a full 8% over the S&P 500, which is relatively flat. So our aggressive portfolio is already taken off. And believe it or not, it's being led by a couple of software stocks and a couple of semiconductors, maybe not quite as much on the semiconductor side, but got a couple of software stocks doing well and a couple other technology names doing really well also. But anyway, that's just part of our service, our portfolios. We have a lot of chart lists, which we consider to be like watch lists, where we do the research and we basically hand it over to our members. I'm going to tell you many hours and hours and hours of research that we do. We annotate charts, hand them over to members. I think you'll really enjoy the service. So if you haven't tried it, 30 days for free. Make sure you check that out. Click on that button. And if you scroll down, if you're just, coming across our channel and you want to learn more about us, best way to do it is we have a free, totally free, no credit card required, free newsletter, Earnings Beats Digest, name, email address, all it takes. Normally we do send out our EB Digest on Mondays and Wednesdays. If I happen to be busy one of those 2 days, sometimes it'll go out the next day, but usually it's Monday and Wednesday. But if you sign up, name, email address, we'll get you on the list. We like to talk about the things that are important to us at Earnings Beats. So you're going to see a lot of articles that talk about relative strength, that talk about price support and resistance, that talk about breakouts, that talk about earnings gaps. Those are a lot of the things that we like to talk about and things that we follow in our trading routine. So make sure you check that out. Also, if you do like what we do here, hit that like button. That really will help us. Even if you can't subscribe to our service, we get it. We're probably expensive for a lot of folks. I think we're worth every penny. But if you can't afford us for whatever reason, still make sure you like the video, subscribe to our channel. All of that will help us in the YouTube algorithm, which will help us expand our business and reach more folks. So we certainly would appreciate that. All right, let's take a look at these Mag 7 stocks, because we just talked about Mag 7 and how important it is to the S&P 500. What's going on with these stocks and where might they be heading? Well, Apple right now is kind of in a sideways consolidation mode. The AD line maybe drifting a bit to the downside. I would say price action right now is maybe in a symmetrical triangle, but I haven't looked at any of these stocks in pre-market. So I'm going to, let's just pull this over here. I never did on the S&P 500. Let me just go down and show you these ratios. There, that one's going down. Here's discretionary versus staples, large cap growth versus value, large cap growth versus value, mid cap growth versus value, and small cap growth versus value. The only one really rising. So I didn't show you those. I apologize for that. But anyway, just wanted to point out the ratio is not looking very good. Oh, and then let's take a look at these Mag 7 stocks. So pre-market, Apple, only down a half 1%, 263.40. So Apple hanging in there pretty good. I still think looks like it's in this symmetrical triangle, squeezing after an uptrend. Like to see a breakout here. We'll see what happens. Next up would be Microsoft. Let's take a look at Microsoft. Microsoft down 2%, 390. Let's see here what Microsoft looks like. Microsoft is obviously downtrending. 390 just kind of puts it still in the downtrend, but not a new low. This is an area that here was the bottom of gap support, which was in the 390s, probably about 392, 393 from several months ago. That's where I was originally looking when we came down, or when we were coming down on Microsoft. I was really looking at 422, 423 first as support, and then this 393 level. And so we've already taken out the top. We've actually gone down. We've now filled the gap. What we need to see on Microsoft first is just to move back up above its 20-day moving average and then see if we can get it to stick. My guess is we have a positive divergence, which will help, and we do. Well, it looks like a slight positive divergence. Lower prices, PPO starting to turn back to the upside. So if we can get a breakout above the 20-day moving average, maybe we will get that move, a little bit more of a move up, maybe all the way to the 440 level. But right now it seems like a long way away, especially given the way the market feels this morning. All right, NVIDIA. This is the big semiconductor. This is the largest company in the world, market cap wise. This has the biggest impact of any stock on the S&P 500. And you can see the stock down another $5 at the open, almost 3%. And when we come over here, NVIDIA, I'm still looking at this gap support way back here at about 163, 164. I think that's the biggest level on the NVIDIA chart. Yesterday, we did gap down and recover. We opened at 175.01 yesterday. Today, we're right now looking at 177.46. So still above that level. If we can start to hold on, I mean, the Apple doesn't look bad. If NVIDIA can hold on to this support area, if the Mag 7 stocks can kind of start to turn around a little bit, it would certainly help the S&P 500 avoid a more significant loss. All right, Meta. What's Meta doing pre-market? Down 10, 1.7%. That's 642. And then, of course, Meta right here. So that's going to be 642. I mean, we still got pretty good support down closer to 625. So we are still hanging above it. Google down 3%, down to 297. Google, that's going to be a new low, it looks like, on Google at the open. Let me see what this low was right here, 296.72. So that's a level I would watch pretty closely. If we open below that level and don't really see any buying interest today, that would not be a good sign in the short term for Google. Next up, let's try Amazon. Amazon down 2%, back to 204. And 204 would take us right about to where we opened yesterday at 204.55. Seeing some hollow candles. Let's go back over to that relative chart. You can see the AD line is actually starting to go up. See all these hollow candles? That's why I wanted to look at the AD line, because it does look like with this move to the downside that there is some accumulation taking place on Amazon, which is noteworthy because we are kind of down here testing this gap support level from about 193 up to about 198. Got down as low as 196 recently. So I don't know. There could be some accumulation. I think Amazon looks kind of interesting here, although I'd like to see a breakout back above that 20-day moving average. And then the last of the Mag 7, Tesla, down another 9, 10 bucks, 393 today. And Tesla, well, 390 is where we opened yesterday. You can see over here about 385. So we're still above the key support level. So it looks like the only one that's really in potential trouble at the open would be Google, based on where their support levels are. Microsoft, Apple, everything else still holding on to recent lows. So we've got the S&P 500 now down below those that key support at 67.97. But all the Mag 7 are holding on to their most recent lows. So if they can continue to hold on support, remember, that's a big part of the S&P. So they could help limit the damage. But if you look at the Mag 7 today and they start rolling over and the selling starts picking up, that's when we could have some bigger problems in the market. So kind of keep an eye on all of that. I mean, energy probably going to do well. Crude oil prices have been, on the move to the upside. We can pull that up. You can see the huge move yesterday in oil prices. Didn't look today, but I'm going to look right now to get the latest on the oil. Um, 9% higher right now. Oil, $78 a barrel. So all the way up to the high that we saw in June of last year. So my guess is we'll see energy do well, maybe materials. I don't know, industrials, which have been holding up pretty well. Maybe some of the defensive areas might do a little better, at least on a relative basis. But watch to see those key areas, technology and financials. So if we look at technology, you can see this is the key support level. It goes back 6 months. Get a little bit better idea here. See these levels coming across 135 low, no close 136, 135, gap support 134. We've had some intraday moves below that, but 134 to 136 is where the candle body support is, opens and closes. So let me see where we were. I think we were 136 earlier. 136.34. So we're right at this support area. Watch technology. This is 33% of the S&P 500. If we lose support, then you've got 33, 1/3 of the S&P 500 losing support as a group collectively. That would not be good. So these are just some of the keys to watch. Again, I've talked about these warning signs really for 3 months. So nothing new to anybody who's been following us at Earnings Beats. I mean, been talking about this market struggling in the first half of the year, maybe even throughout the summer. I think it's going to be a much stronger fourth quarter. I think a year from now, I don't think we'll be looking back worried at all. I think we'll be sitting at all-time highs. But between now and then, not so sure. I think we got some issues to battle through. And how low does the S&P go while we battle? I think that's the question. All right. I want to just go through. So I mentioned earlier that, we do a lot of these lists for our members. We do a lot of research. One of our lists, our flagship, in my opinion, is our strong earnings chart list. This, in my opinion, is when I'm looking for trades, this is the first list I go to. These are companies that are already executing at a high level. Their management teams are executing. They just beat Wall Street estimates as to both revenues and earnings in their latest quarter. I like something about them from a technical perspective. Either I like the way the stock is performing. Maybe the stock isn't performing so great, but it has a really strong AD line and is part of a better group, one of the strongest groups. That might help get it into this list. But there's got to be something technically that I like. It's going to be a stock that's over $5. I always filter out stocks that trade $5 or less. And it's going to be a stock that's liquid. We're not going to put stocks out there for our members that only trade 2,000 shares a day because you literally can get whipsawed in stocks like that. But you can see some of the stocks. I mean, look at what was leading yesterday. We saw a big bounce back in technology. So many of the technology names, some of these names are not names that were getting beaten up, even though I just showed you technology down near support levels. LASR, Laser, VIAV, this is in our portfolio. This is the one that really boosted our aggressive portfolio yesterday, jumping 19% in one day. Coherent looks good. Light, this has been one of the best telecom equipment stocks for a while now. Fastly, this is a software company, also in our aggressive portfolio, up 11%. There are winners out there, but you really have to be selective in this kind of market. I've been telling members for a long time, I primarily stay in cash. I'll trade during the day. At the end of the day, I try to get out. For the most part, I get out, or I have very, very little that I carry overnight. I just don't want to wake up to what we're waking up to this morning. When the volatility's up, you can wake up to the market being down 2, 3, 4% at the open. And I don't like that in my portfolio. Call me crazy, but I don't like it. And so I prefer when the market's like this and we see all the signals that we've been talking about. I don't want the exposure. I don't want that risk. Trading and investing is all about managing risk. Everybody thinks, well, I'm just going to buy a stock and see if it goes up or down. It's not the way. That's not the best way to approach the market. The best way to approach the market is to assess risk first. From there, develop a strategy. That's what we do at Earnings Beats. And I've been talking about the fact that the risks are elevated. Doesn't mean the market's going down. I don't have a crystal ball. All I can do is tell you when I think the market is potentially in trouble. And then just whether or not we start to see breakdowns. Today, we may see that breakdown. We'll see. Also, raised guidance. We have a raised guidance chart list. And so you can see some of these same stocks not only beat in the last quarter, but they also raised guidance. Management teams are confident. They beat and they raise. Those are the best companies to trade for the most part. And you can see many, many winners yesterday, even though the market was flat. Many big winners. Now, if you are on the strong earnings chart list and you're on the raised guidance chart list and you're on the strong AD chart list, which is accumulation distribution. So when I talk about individual stocks, like let's go back over to, let's see, well, Viavi would be a great one. Pull up the relative chart. Look at the AD line. Now, forget about price action down here. Just look at the AD line. AD line's been going up consistently for the last year. That stock is almost automatically going to be on our strong AD list. So when I'm looking at the strong AD, that's what I'm looking for. I'm looking for companies that have strong AD lines. They go on here. Now, if you are on the strong earnings chart list and you are on the bullish trifecta chart list and you have a strong AD, you will get on what's called our bullish trifecta chart list. And there are only 43 stocks that are on this list. This is a pretty prestigious list. We update this for our members every week. And so, I mean, there you have it. Let's see what they're doing today because now the market has just opened. One stock on this list is up. These are the best stocks out there. That'll tell you something about the market. But I mean, out of the 43, probably 10 or 12 probably are beating the market right now. Let's just go back and see what the market's doing before we wrap up. We got the S&P down 1.5%, NASDAQ down almost 2%. So pretty rough start to the day. Look at the VIX. The VIX up 16.5%. Was up to 2730 earlier. Now it's at 2499. It was up. I tell you what, if we break out to about a 10-month high and you see this VIX up in the 30s, that is a very, very strong signal that you could see impulsive selling. In other words, selling where it just is going down big amounts with almost no buying whatsoever. Market makers go on vacation. They don't support the market. That's what their job is, but they don't do it. And that's when the market starts to fall rapidly. So I don't know if that's what's in store. I'm just telling you something to watch for and to please be careful out there. Wish I had better news, but I report exactly what I see, and that's it. So not looking really good here at the start. Bulls got their work cut out for them today. Have a great day, everybody. Happy trading.